So one of the main things about risks that I learned over the last 25 years is that volatility in the financial markets and, for example, implied volatility that you can see in options has nothing to do with the real risk. So what we learn is that we calculate the standard deviation of a kind of a market, a stock or a bond, and we say that's the risk. But that standard deviation can go down for several years in a row, and risk can get higher and higher. Like in the period 2002 to 2007, all the markets went up and volatility went down. Just before the crash, volatility was extremely low. So volatility is a very, very bad measure for risk. We confuse risk with what we measure in volatility, and investors have to get rid of that idea. Okay. What investors could do is, instead of when markets go up and volatility goes down, they have to ask the question, what is the real risk? And they have to make event scenarios and think, well, this can happen to my portfolio and that can happen to my portfolio. And the higher the price earning in the market is, the higher the price of a stock can fall. And so you know for sure that volatility is not a good measure, but just things like price earnings or house prices compared to income, and these kind of indicators are much more reliable as an indicator for risk. It's not that you can predict when the market will collapse, but at least you know that the risk is getting bigger compared to the return that you have in your stocks, for example. Yeah, today we are in the Western world, especially, for example, in Europe and the United States and Japan, I think, and maybe in the entire world, we are in a world where the central banks are buying lots of bonds, and the bond market is going up, so the interest rates are going down and money is going into the stock markets. And stock prices are extremely high. House prices are even rising in some markets that have just experienced a disaster in their housing prices because there is no alternative. Financial assets are the only thing where you can invest because there is no interest rate. Interest rates in Europe are almost zero. And so we are in a bubble today, and that's really, really tricky. And even in China there's a bubble, in Japan there's a bubble, in the United States there's a bubble, and in Europe there's a bubble. So it gets very difficult for investors to avoid that bubble. So what happened in the period before 2007, 2008 was that private debt was growing and growing and growing, and that fueled the financial markets, and everybody became euphoric and started to borrow more money, and then there was this crash. But then we had to get rid of this debt, and the private debt is now going down in the world, but it is replaced by government debt. So governments are more and more indebted, and that's getting really, really tricky. So they have to do something in the future to get rid of this debt. The entire Western world has to get rid of the debt, and that won't happen without pain. So there is the likelihood of having huge periods of growth and high returns in financial markets, because people are spending a lot and companies are flourishing, is very unlikely. It's more likely that we have low growth areas and low growth periods without people spending too much, without governments being able to spend too much. And that means that we will have a low return environment the next 10, 20, maybe 30 years.
Sure.
And what does it mean for an investor? The first thing that investors should do is adjust his expectations. If he starts to promise to everyone in the market that he can make 10% the next 20 years, 10% a year, every year again, then he's fooling himself and he's fooling his clients. And so pension funds, private investors, everyone in the world should accept that we are in a low growth environment and that we have to accept low returns for the next few years. And then the next question is, of course, how do you get to this return? How do you construct your portfolio? And then the real issue is, how do you get into a stable portfolio? If bonds, in the past there was always, you had bonds and you had equity. Bonds were safe, equities were unsafe. But today bonds are unsafe. The bonds are just totally inflated in Europe, in America, and in Japan. So what's safe today was not safe in the past, and the other way around. It's not that equities are safe now. So you have to diversify over the entire world, and even then, because it's so linked. So there is no simple recipe for investors, but the only thing you can do is to diversify in small bets around the world and make sure that they're not linked too much to each other. And that's very difficult because most markets are linked. If China now starts to get into a crisis, then that will hit the rest of the world as well. just as that Europe is influencing Japan and America. So it's very difficult for investors. It will be a much harder environment than in the 1990s, that's for sure. So that there are many scenarios thinkable, of course. One of the simple scenarios is that the equity markets will simply plunge with 50-60%, just like they did in 2008, but without a recovery. But then the bond markets are so extremely high now, they can also plunge with 20-30% and even more. So that's different from the past, when usually when the markets plunged, then the bond market at least went up. And that scenario is now totally gone because there is no room for lower interest rates and higher bond markets. So the bad scenario is a lot of losses in both bond and in equity markets. The good scenario is, of course, that the central banks remain irresponsibly aggressive and buy the bonds, and even like the Japanese central banks, they buy equity directly in exchange traded funds. So either indirectly or directly, they are fueling the equity market, so they can still go up with another 10-20%. You never know. So the upside is still 10-20%, the downside is 50-60%. The problem with investors today is if they stay invested in the normal equity markets, then they have a huge downside risk and maybe limited upside. Although the probability of upside is higher, but the impact of downside is also higher. So the world doesn't look very stable today, and what should an investor do? And what he shouldn't do is put all his money into equity. That's much too dangerous. But flying into bonds as a safe haven is not a safe haven as well. So what he should do is invest in a very diversified portfolio of projects and infrastructure in real estate, a little bit in equity markets across the world, and diversify as much as possible. A little bit, of course, in cash, because the world, even cash doesn't deliver anything. The risk premium of cash is 0%, but maybe the expected return on equities is minus, it's negative. So cash as part of your portfolio is not the most stupid thing to do. Other things people could consider is a small amount in gold, for example. I mean, not that gold is expected to deliver a lot of return, but if things really go down in the entire world, in China, in the United States, in Europe, then gold can be one of the safe havens at some point in time. So what central banks are doing today is unprecedented, and some people think, and it's not unimaginable, that at some point the whole monetary policy in the world will just stop working and we don't have any monetary economy anymore. So people lose trust in the entire economic system and the monetary system around it. That's some of the possibilities that we are entering into because of this unprecedented experiments with money. And with unprecedented, I don't mean that we do 10% more, 20% more than we ever did before, but that we do 10, 20, 50 times more in experiments with monetary money and expansions and quantitative easing than we ever did before. These are experiments where we don't know how they will end. But one of the scenarios is that they will ruin the monetary economy as we know it. If you look at bubbles, we saw bubbles in Europe, we saw bubbles in the United States, we see them all over the world. And now, in the past, there was always, yeah, but China will help us. Well, China is now in a real bubble in the stock market, but also in the cities, in the real estate market. For a very long time, there is a bubble in China, and everybody sees the bubble. And it's still, people want to be part of it because in China they want to invest because markets go up. And if markets go up, you want to be part of that. Otherwise, you're one of the greater fools who is not investing in these markets. So this is the traditional Minsky type of bubbles, and that's exactly what's happening now in China. And the bad thing is that we always relied on China as the last resort, because Asia and China will help us out of the crisis. So this is another last resort that's not working anymore. Central banks will not work anymore for us. China will not help us anymore. It's all very unstable. So the question is, how do we solve this? And I think one of the main reasons I made this film is education. If we don't adjust our economic education to human nature, and if we don't accept that we are irrational and we can be collectively irrational, politicians can do collective irrational actions at the same time, and people trust them, or people trust economists, but they just ignore the fact that we are human beings and that we have these irrational tendencies. If we adjust economic theory to how we behave as a human being, we can also, if these people get educated and they move into the banking sector, they move into the central banking, into policymakers, they will be aware of our human behavior and they will come up with solutions that are much more robust against financial crisis than we have today. So one example is, for example, if markets really bubble and you see that people have these irrational tendencies and price earnings go up and house prices compared to income go up, what you can do is you put, as a central banker or as a regulator, you put a brake on the amount of money that people can borrow to buy a house, or people can borrow to buy stocks, borrowing on margin. So that should be a anti-cyclical policy made by the central banks and by the regulators. But what happened in the past is every time things went very well and people became euphoric and started to borrow money, the central banks start to help them and the regulators start to relax the rules and the government starts to relax the rules and everything became more and more pro-cyclical, and we have to go to a policy that is more anti-cyclical, and then you need to understand that people are not rational. People can be collectively irrational.